Good morning, everybody. Welcome to the second of our webinars in relation to some of the feedback that we wanted to provide to our banking contacts and clients. And today's webinar is questions our clients are asking of their lenders. For those who don't know me, I'm Darren Stacey. I'm an Executive Director and I head up our debt advisory team. I also lead the finance solutions offering of BDO nationally. My background is banking, and I came across to BDO about 4 years ago, but have continued to work with banks both here in Queensland and to a certain extent in other states as well. I do understand most of our attendees today are from Queensland, but the content is relatively broad. For those who are sitting at home in their pajamas, with their coffee in hand, that is how I would look if I was in the office. I must admit I'm not wearing the tie and the suit today, but I did manage to get up and clean myself up. Hopefully when we all get back to work, we won't find it too much of a challenge to do that ourselves. So what we'll cover today, I wanted to just give you a little brief snapshot on the QRIDA Business Support Loans and how that's developed. BDO has been assisting the state government in administering some of those loans, and I just thought there's some interesting takeaways that our bank clients and contacts would be interested to hear about that, as we've seen what's happened on the client side of people applying for those loans. I also wanted to touch on just briefly the bank support announcements. You all know what provisions you've made for your borrowers and your clients, and I just wanted to provide a little backdrop as to how our clients are seeing those bank support measures and where they've done well, but also where it's been a little patchy. Finally, then I wanted to cover off on some of the key questions that our clients are asking of their lenders and some of the challenges that they've had, but also where things have worked well. And then we'll finalise it with sort of what I see as coming down the pipeline, what's coming next, and what we might need to look out for. I just wanted to flag at this point that all of the case studies that we will use today, I'm not using any names, either of our clients or of their banks. I guess we'd call this Chatham House rules. And so, but because you're our banking contacts and clients, I'm certainly going to share a little more with you today than perhaps what I would share in a public forum. But yeah, we won't be disclosing any names. So, the QRIDA Business Support Loans. So what we saw, this was one of the earliest measures that came out even before many of the federal government schemes. The Queensland government decided it would provide a loan scheme of up to $250,000 for businesses employing Queenslanders. It was announced on the 17th of March, and then there was a sort of a week and a half where they allowed people to register their expression of interest, and then applications opened on the 26th of March. The government during that sort of first 10 days recognised that they were unlikely to be able to facilitate the administration of all these loans through their QRIDA arm. While they do loans primarily around drought assistance and other measures, their team wasn't sufficiently large to cater for what they expected was to be the desire for these loans. And BDO were approached, and we've provided some people up at QRIDA virtually to help with these loan applications. What we did see was there were about 1,000 applications being received a day for the first couple of weeks, and it didn't take long before we realised and the government realised that the initial $500 million that was announced as as the total loan scheme available was actually unlikely to be sufficient. And as we've seen, the average loan request was about $150,000. But as you can imagine, there's all sizes of businesses. There's many small businesses in this scheme who might have only asked for $20,000 or $30,000. But then there were some quite large businesses who capped out at the full $250,000. The dollar figure that applicants were eligible for was based on the wages bill of the business over the last 2 years, and in fact it was limited to 50% of that wages bill. So you can imagine, obviously, with a loan size of $250,000, that means an average wage bill of over $500,000. The government always expected that they would be generous with their consideration of applications, and we have seen that the approval rates have been generous. They were very keen to ensure that as many people as possible, within reason, were able to access the loan scheme. Another reason why that $500 million was absorbed very quickly. And just a few days ago, you will have seen there was a press release, and the State Minister, Mark Verner, has confirmed another $500 million is available, taking the total scheme to $1 billion. This is just a snapshot of where many of those applications came from. This was a few days ago, but I don't think the map changes dramatically. Interesting to see that most of the applications have been in southeast Queensland, and while there are a number up in Townsville and Cairns and along the coast, there was actually very few that have been received from businesses inland. And while we acknowledge the population is heavily skewed to southeast Queensland, it does show that that's where the majority of the funds are likely to land. Some of the key points out of that, we just wanted to flag that a lot of people were inquiring initially as to whether or not the money was a grant. The government was very clear, it's a loan. It does require repayments, although the generous aspect of the scheme is that there are no repayments needed in the first year, and then gradually interest is applied, and then principal repayments after that. Interestingly, and this is the key points that I wanted to raise with you today, in the consideration that the government had for these loans, obviously where you have an interest-free loan, at least initially, when you look at what the interest cover ratio of a business is and you add on extra debt, but that debt comes with no interest in the first 12 months, it's really hard to see any change, obviously, in your interest cover ratio. And so, again, the approval rates were generous because in reality, anybody who had a reasonable interest cover ratio prior to the application was likely to still have a reasonable interest cover ratio afterwards, all things being equal. Now, of course, we know that the COVID-19 crisis has caused a lot of businesses to have revenue impacts and profitability impacts, but given this scheme was designed to be rolled out quickly and the analysis primarily was on a historical basis, there was very little way of the government understanding what the real interest cover ratio might be going forward. And so while they have been able to provide loans to these businesses, I suspect there are some challenges coming down the track when the interest rates do kick in, because there really hasn't been the ability to have much analysis on where these businesses will be tracking. And to be fair, I suspect even the business owners weren't really able to provide a very good answer as to where their forward profitability and cash flow was looking like going. Interestingly, also in the analysis, the government expected that clearly the loan adds to the liability side of the balance sheet, But rather than there being an asset, and of course drawing down the funds provides you an asset, the cash, on day one, but these loans were designed primarily to cover wages costs and other expenses of the business. So the analysis was that we anticipated businesses would have a reducing net equity position because the liability would sit there, but the cash would be expensed or expended on expenses. So in that regard, they recognised equity would reduce. And the loan scheme itself, it was unsecured if it was under $100,000. So it's an unsecured loan, but if it's over 100,000, it was going to require a GSA be provided, and that would be second ranking where necessary. And obviously, many businesses have debt already. Many of your business clients now may well have a QRIDA loan sitting either unsecured or second ranking behind you as a lender. So how does that sort of tie in? And obviously, there's new debt on the balance sheet. And so, as I mentioned, there's no cost now, but interest will commence in due course. And while the interest rate itself is quite reasonable, in fact, very reasonable at 2.5%, it is an additional cost. For many businesses, additional financial indebtedness is a potential event of default, depending on the amount. And that is, a possibility that it would cause a default. The question I posed is, would a bank take action? Clearly, we're not seeing the mood of banks at this stage to take any action over, for instance, a QRIDA loan. However, I do imagine if this has taken a business from a position where its profitability and its gearing was already marginal and tipped it into a point where it is perhaps insolvent, or there are other negative issues arising out of it, it will be interesting to see in due course whether or not the additional financial indebtedness is viewed favourably by the main or primary lender. Given the interest rate and the generous repayment terms, the feedback we've had is that there's very little incentive for businesses to repay this QRIDA loan in advance of any other indebtedness, on the basis that they have a 10-year term, and the P&I payments, or the principal payments, don't commence till later on in the loan term. Many businesses have advised us that they expect to, where possible, use any free cash to repay their other financial debt, be it leasing or core debt, or reduce their overdraft, which is great. That's probably a good thing from your perspective as bankers. But it also means that this QRIDA debt remains on the balance sheet for perhaps many years to come. And while it may not matter in many cases, and perhaps does not matter much at all if it's unsecured, where it is secured and there is a second ranking GSA, there is no intercreditor or subordination deed, and therefore there's no formal mechanism or arrangement between QRIDA and the primary lender, but it does potentially limit new lending by the primary bank. So that will cause some interesting discussions, I suspect, in due course, perhaps not now, but certainly down the track, where businesses perhaps get back on their feet, or even they need to approach their primary lender for additional funding at some stage. How those discussions unfold may be a challenge. So I just thought that was useful perhaps for you to understand what we saw out of this QRIDA loan scheme. They are still assessing loans, and they will look to provide the remainder of the fund over the next couple of weeks, and then I think that will be the end of it as far as I'm aware. So moving on, I just wanted to cover off briefly the bank support announcements. This is not something that will come as a surprise to anyone. You know about all of these. In terms of, I just thought I'd touch briefly, I'm not going to spend a lot of time on retail support provided. So for home loan customers or individual customers, But basically, the banks have been lauded for their conduct in this regard. It was something that I think has made a massive difference. Certainly, since the Royal Commission, there was obviously a perception out there across the media, at least, that banks hadn't always acted well in regards to their customers, but the speed at which banks moved to provide support, primarily with repayment holidays, has been very well received. And the fact that banks did it quickly and uniformly across large swathes of the population, and in some cases they were able to do so in a process where it was automated, so there's very little difficulty with people accessing this support. That's been very well received. So interestingly, and again, different banks have taken a slightly different approach here, but we even saw some of our retail clients where they had applied for home loans. They may have gone unconditional on the purchase of a house, but then had either lost their job or been stood down from their job. We have actually even seen banks proceed with the settling of a loan to allow them to purchase the house and then automatically switch straight into a repayment holiday. Clearly, banks would have had the right to pull those approvals potentially, or at least flag that they were not comfortable to go ahead, but that may have put those retail customers into greater financial difficulty if they were forced to cancel contracts and lose deposits. Clearly, they're not out of the woods. If they've lost their job, they will have challenges, but I think banks have really taken the hardship approach even to those customers who were not yet drawing down the money. Again, I think from an overall perspective, that was well received. I do suspect there'll be some difficult discussions in due course, but on the retail side, the banks have done very well. For businesses, it's a far more complex picture. We know that most banks have asked their business clients to come and talk to them directly. So rather than roll out any generic support programs, they primarily ask businesses to come and talk to them, and that's reasonable. We know that not every business is affected in the same way. We do know too that the message was partly confused when the government came out and said they wanted to back unsecured lending up to $250,000. We noticed it took some time for many of the banks to respond to that, and I don't doubt that some of that time was taken up with internal discussions about how best to support it and how they were able to actually put that in place. When you've got a government guarantee for 50% of a loan, how do you actually record that, and how do you make sure you can properly manage it? Would not be easy, I am sure. But many lenders have now come out and agreed that they would support that. I'm going to circle back on that point in a minute, but yeah, that was challenging. We do know that borrowers were asked to come and make their specific requests. From our perspective, we know many borrowers immediately put in requests, but not all of them were well thought out. Some of them just immediately thought that they would get a repayment holiday just like they got in their home loan, but they didn't necessarily provide good supporting evidence to the bank as to why they needed that or to what level. Many businesses asked for support without any real evidence that they'd even been impacted by COVID-19, and that's challenging too, because at the time many were forced to shut their businesses. But if you're working off year-to-date management figures, and you've only got figures from a month ago or a month and a half ago, it doesn't yet show. And so a lot of the support that they tried to provide banks where they did was anecdotal. It's really hard to provide a forecast when no one really knew how long this was going to take. And even if they did have a guess as to when they might open again, no one really knew how it would happen or what their demand would look like once they got open again. So we've seen very few of our clients be able to provide a forecast with any real basis or any scientific approach to it. A few people have had a stab in the dark, and that's been really hard, I'm sure, for you bankers to try and understand how best to support businesses when they don't even know the level of support that will be required. We did see one or two cases where people suddenly asked for further time or support for various reasons, when in reality their business was already underperforming and COVID-19 was used as the reason. I think on the whole though, bankers were able to look through that and they were already aware when businesses were struggling. So on that basis, I just wanted to go through a couple of case studies and discuss the requests that we saw our clients make of their bankers and the responses, and why there have been some complexities to it and where there are the challenges. So on this slide, I'm just going to cover 5 of these requests, 5 case studies, just in a high level, and we'll just go through why each of them are unique and interesting. So the first one, a retail landlord, clearly high profile from a media perspective. This is a retail landlord. They own shopping centres. They have multiple outlets and obviously many tenants. Where they in the early days, there were some tenants who closed before the restrictions were announced by the federal government, and then obviously more closed after that. But of course, some tenants were doing well, and where you have shopping centres and pharmacies and businesses like that, they've still had income streams coming through. Our client estimated that the impact would have been up to 25% of rental income reduction on an annual basis. So thinking about their profit and loss, they think that they'll have a 25% either reduction in revenue or increase in costs, because in some instances they were actually providing extra support to tenants to get them through this this crisis, but still asking for the rent to be paid. But that's a large amount. Interestingly, though, in this case, they had funds on hand. They had cash available or liquid assets in order to be able to support their business. They did not ask for a repayment holiday. They have sought a deferral of valuations, and the interesting discussions there when they had commenced a valuation process, and the valuers themselves had advised that they were not sure how they would be able to value a retail site, because in their view, I think the valuation requirements from the Valuation Institute is that they cannot include any rental income from a shop that has closed its doors, even if that closure is potentially temporary. And so how do you value an asset when the structure is there and the possibility of renting that store or getting rental income from a particular store is there, but the time frame is uncertain, and for the purposes of today, the rental income is not being received or not being counted as being received, and therefore I don't even think the valuers knew how they were going to value the centre. So in that regard, the valuation deferral request, in our view, seemed reasonable, and that was the primary request that the client had of the banks. Interestingly, at this stage, they have not sought any waivers of covenants or any amendments to covenants, but I imagine that will be a discussion as we get closer to 30 June. The second case study is a professional services organisation. They were in the middle of a refinance. They had reasonable working capital headroom, but no initial impacts from COVID-19. However, they did expect that in light of the general economic impacts, that they would expect a slowdown in work coming through in future periods. So probably not a great deal in this financial year, but into next financial year. And obviously the time frame for that slowdown is uncertain. And so they sought additional working capital availability or headroom, but no initial need for actually accessing the cash. So that was the request that they made of their bank. Another one, very, again, interesting vehicle dealership. While at face value, I would have thought their business would have been severely impacted. It was interesting to see that there has been actually little change in revenue. There has been some impact, but not major. Certainly sales have declined, but they're actually providing more service support for their clients, and in fact their service income is significantly increased. And so that was interesting in that their business performance hasn't been dramatically impacted. It is off a bit, but they were seeking finance for the repayment of the final tranche of vendor finance. So that's effectively where they're looking for bank debt to swap out what was debt from the vendor, which means the overall level of debt within the business wasn't going to change, but obviously they're seeking support of their lender to put more money on the table at a time when there's a great deal of uncertainty. Our fourth case study is a medical specialist, and unfortunately for them, their services were non-essential procedures. And as a result, not only is their business closed, but there is, at this stage, not a very good outlook for where they're heading, because even once things reopen, we suspect that in a time of tighter economic conditions, some of those non-essential procedures might be deferred or delayed or cancelled altogether. They were already having some issues pre-COVID-19, and they were seeking more time and support from their bank to achieve a restructure and a debt paydown. And lastly, our fifth case study is a renewable energy. Sorry, that should read renewable energy project finance. They were seeking project finance for the construction of a renewable energy plant, and they have in place a executed contract with an ASX blue chip company for an offtake of that energy. Their risk is largely unchanged. The ASX blue chip entity is largely unaffected by COVID-19 and are still comfortable and willing to proceed. And they are looking for this project to get started. The financial structure of this project, though, is that it is relatively highly geared, and so it is not necessarily going to be the easiest one to seek finance for. Interestingly, the borrower has actually sought support from their bank via this government-backed unsecured loan as a bridge prior to the project finance being put in place. And so that's the request that they've had of their bank. So the question is, how have the banks responded in each of these cases? And while we get to the actual responses of each of the case studies in a moment, I just thought I'd touch on some of the general themes we've seen, and then we'll go through how the banks have looked at each of the individual cases. So, interestingly, this government-backed unsecured loan scheme, I don't believe has been picked up in any great number, certainly not by our client base. There is a bit of a question around, the availability of this scheme for new clients of a bank. And while I believe every bank has formally announced that they are open for business for new and existing clients for this government-backed unsecured loan, as far as I'm aware, there's been very, very few new client or new to bank clients who have been able to access it. Normal credit criteria apply, and when you're looking at a unsecured loan in this time period where there's uncertainty as to revenue, uncertainty as to profitability. Normal credit criteria would suggest that it's pretty hard to get an unsecured loan for a client in many cases where there's no real certainty. The other interesting part, though, is that we have heard some anecdotal feedback where banks, in discussions with our clients, have made the comment that if they were to, so these are existing bank clients, where they have made a request for an additional unsecured loan under this scheme, that the bank would actually take a negative view of the client's prospects off the back of the need to access that, and therefore that was likely to negatively impact their risk grade. The whole risk grade discussion is an interesting one. Clearly, you can make some subjective adjustments to risk grades, but if you're still working off the same 30 June 2019 financial accounts and maybe 31 December year-to-date accounts, it's pretty hard to have any real quantitative impacts reflect through a risk grade, given we don't really know what those impacts are until the financial accounts of a borrower are fed into a risk grade model. So the fact that some banks have taken a view of downgrading risk grades off the back of a request for these unsecured loans is an interesting approach. I'm not saying it's wrong, but it obviously makes it difficult for those borrowers to perhaps access that unsecured loan without any other negative effects. As you could imagine, banks are asking for the impact or the evidence of the impact of the COVID-19 restrictions before committing, and that's an absolutely reasonable request. The challenge again is for many borrowers, it's anecdotal evidence. They can point to how much sales are off in the last week, last month, but until those financial statements get provided, really hard for them to provide solid evidence as to what it really looks like. Another interesting discussion, or a theme of discussions which has come out, is really on whether or not the primary banks for our clients are acting as a backstop or as a cushion. And let's just dig into that a little bit. What I mean in terms of a backstop is there have been some banks who have said to their clients, we are here to support you, yes. However, we want to know that you are doing the hard yards to protect your business before we'll come to the party. So we want to know, have you applied for JobKeeper? Have you applied for the other government schemes available? Have you looked at reducing your expenses? Have you negotiated with your landlord for a rent reduction? Once you can provide us some evidence that you have done those sorts of things, then yes, we will look to support you. There are other banks, though, that have made the decision that these are clients that we know well, that we have backed historically. We know that they are good business people. They have asked us for some additional support, working capital, or they have asked us for a repayment holiday. We know that there is a lot going on at the minute, and we're going to say yes to that. We're going to provide that support, and then we will look to work with them as they go and do all of those other things like negotiate with their landlord or go access government schemes. Obviously, the approach is a little different. I'm not sure which is the better approach, but some have forced the hard work on the clients up front, and some have said, well, we'll work on it with you together, or we'll support you today while you work on it, and then come back and talk to us. So different banks have taken different approaches, and we're yet to see which is the better approach, but it obviously has meant that some people have gotten access far sooner than others. Most banks have centered their support on short-term measures, which might be 1 or 2 or 3 months worth of repayment holiday or working capital, but have not looked to provide long-term solutions, restructures of any sort, which is fair enough, I think, because at the time that most people are making these requests, nobody knows how long this crisis will continue, and nobody knows, even if it finished tomorrow, what the residual effects will be. But what it probably does mean is that those relationship managers out there are going to need to do many more monthly reviews or quarterly reviews and continue to put forward papers to their respective credit departments seeking additional measures of support potentially down the track. That just means a lot more work in terms of managing those existing clients. But of course, that's sensible. It just means additional work. There has been some banks who have provided additional limits, additional working capital limits, as opposed to just turning off the interest payments or the principal repayments. Very few banks thus far, I believe, in terms of my experience, have provided covenant waivers. I don't see that as an issue. I think many banks will be reasonable in that regard. But of course, a lot of covenants are tested perhaps only semi-annually or annually. And so, again, nobody really knows what sort of a covenant should be put in place come 30 June. And that testing itself may not be till the financial accounts are provided, which may be some months later. So I suspect that will form part of the requests that will come in the coming months. So those are the themes. So in terms of our 5 case studies, I just wanted to provide the background, the responses that the banks have provided in each individual case. For our retail landlord, where the borrower had committed additional equity to support the tenants and to ensure that the revenue gap was bridged, I think the banks were very comfortable to support that borrower, and so they have agreed to defer the valuation. No surprises there. It made sense given the valuation difficulties, and as a result, I think the deferral makes perfect sense. It still may be interesting to see how a valuer values a centre down the track, because that will take into account all sorts of things, including comparative sales, all of which will potentially have occurred during a highly unusual time. In terms of the professional services client, given the borrower took steps to reduce expenses and to manage their working capital, the limits were approved. But again, at this point, they were just additional headroom and have not been utilised and not necessary. However, off the back of that, there was a pricing renegotiation. And the interesting part of that is that pricing renegotiation was driven by bank funding costs as opposed to risk grade. We were advised that that client had not been risk graded with no new financial accounts. There was no additional risk grading. They continued to adopt the original risk grading. And so the pricing renegotiation has come off the back of the bank's view on its own internal pricing. And again, I won't provide the exact figure, but we have seen some pricing renegotiations for clients fluctuate between 50 basis points and up to 150 basis points. So that's not insignificant. They're large figures for businesses. Admittedly, the base rates have come off where anything is based on BBSY, but those are large margin increases, as you could imagine. In terms of our vehicle dealership, given the uncertainty as to the future, the bank has had some significant caution on providing additional debt or replacing the vendor finance debt that was in place. They did, however, agree to try and make it work. Their assessment, though, required them to look at that at full P&I with their sensitised interest rates, which are above 8%. Now, clearly, I think we'd all agree that we don't think the cash rate is moving anytime soon. And there's probably very little risk of a spike in base rates anytime soon. I do suspect, though, that the sensitised rates may take into account the fact that some bank products will be repriced in the coming months to take into account bank funding cost increases. But an 8%, well, it's more than 8.5% rate for assessing serviceability is a large rate for a business loan at this point in time. And as a result, the transaction is not going to proceed because the serviceability at 8% made it too difficult for the clients to make it work, and the bank was not going to be able to provide the full amount. So they're actually looking for other alternatives at this point. But it does highlight the conservatism which banks rightly would take in this time in terms of providing new debt for new transactions. For our medical specialist, as you might have guessed, given they were already struggling pre-COVID-19, there was no rush to provide additional support based purely on COVID-19, but there's certainly been no action taken, and in fact the bank is still working with the client to try and find a restructure, but pointing just to COVID-19 impacts wasn't going to solve the problem for this particular medical specialist, and as a result the banks have rightly said, well, you've got broader issues at play and they need to be addressed, but yes, we will still look to support you, which I agree is a very reasonable approach. Interestingly, this project, renewable energy project finance, again, while the risk in our views was manageable and that there is a transaction there, given the borrower asked for this unsecured loan from their bank, and the bank took that as a negative view, as I highlighted earlier, they've actually not approved that. Now that doesn't mean the project finance will not be approved, but the bank was not willing to take a view on the capacity of the borrower to get in place their project finance, and so they were not willing to approve the bridge, notwithstanding they had the benefit of the federal government backing 50% of the loan. And again, I think that points to the caution and the conservatism that banks are approaching any new debt or any new opportunities, given we're really yet to see perhaps how the full outcomes of this COVID-19 crisis will play out. We may well have seen the bottom of some of the worst of the lockdowns and the impacts initially, but we don't know the second or third order impacts. So on that basis, I just wanted to cover off a couple slides on what I think the future holds. I think that banks have done some good work in terms of how they're being viewed in the community and by our clients. Banks who have certainly benefited are those who were very clear on how they wanted to support their clients. They've honoured their existing commitments, even where they may have had a legal right to pull those commitments. And they've identified the sectors that they can support and will support. And they were acting more than just a lender of last resort. They were doing more than just being the backstop. They're actually willing to back a client who they'd previously backed in prior years, and said, we know you're a good business person. We know that you will do what is necessary to keep your business afloat, and we will support you in that. I think the jury is still out for the actions of banks in a couple of scenarios where aggressive repricing is occurring. I don't doubt that bank funding costs are increasing, but there will be some instances, I suspect, where borrowers will feel aggrieved that they're feeling the brunt of the bank trying to reprice its back book when they're making some request for support, and that's requiring the repricing of their entire facilities. I do think that some people will see the patchy use of the government-backed unsecured loan scheme with some caution. I don't know that it's necessarily a bad thing, because I'm not sure the product was brilliantly designed by the federal government when they announced it, but I'm not sure how that will play out. And I do know that some banks have been fairly slow and cautious with providing any support, and they're drip feeding it. And while that probably makes some sense from a risk management perspective, I think their borrowers are feeling like they have no real room to make any decisions, because they really don't know what next month will bring, because they've got to go back to their bank and make another request. I do think that there's some scenarios where banks will feel some challenges in the future, and I think that will come where they have used their legal rights perhaps to pull approvals and leave transactions unfunded, or put their clients into difficult financial positions. I think banks may also find some challenges where they refuse to provide any waivers in order to keep their options open. While that might give you some legal rights, I think borrowers will see that as banks really not providing any support. That being said, I don't propose that banks just provide blanket waivers. I'm not suggesting that at all. We have seen a couple of scenarios where banks have cancelled undrawn limits. So similar to pulling approvals, I think where a client has a committed limit and a bank has decided, which again under their legal documentation they'll have some rights to do so under material adverse changes. I think to cancel undrawn limits again creates huge uncertainty for borrowers who were expecting that liquidity to be available. Some banks have had some challenges internally in staffing where they've had obviously massive increases in customer requests for support, and it's taken weeks or months for banks to get back to their customers about how they'll support them. That time period is just difficult for borrowers to manage. And then probably the last one is sort of where banks have supported clients and maybe given them repayment holidays, but if they then place that file in the bottom drawer and think, oh well, I'll get back to that client at the next annual review, I think that creates some issues, because while a borrower may not have to make payments today or tomorrow or maybe for a couple of months, doesn't mean everything is rolling along smoothly. And I think banks would do very well to stay close to their clients, even where there's no financial payments having to be made, because I suspect that will create I think that they will have borrowers who will fail or who will struggle, and unless the bank is close, they may not identify that in time. So the next challenges, while we will see some easing of restrictions, it will not mean a return to normal in my view. The big issues I see is when banks recalibrate their risk grades, which happens regularly, obviously, when you feed in new data. We'll see the probability of defaults change, I think, dramatically once you get financial accounts 20 through and the banks do feed in the actual defaults that have occurred this year. I think we may see large swathes of the bank books get downgraded. That obviously impacts a whole bunch of things internally for banks, including how they raise funds, how they report, what that looks like in terms of their average risk grades across their book. I think when those annual reviews come through, sometime between September and March, which coincides with the financial statements of the financial year 2020, I think that'll also coincide with the end of these repayment holidays and the end of the government schemes. And doing an annual review when the financial accounts have shown a dip into losses, and when you also have risk grade downgrades and forecasts which don't show a very rosy picture at all, I think that there will be some really, really challenging discussions about rolling over facilities or renewing facilities. So I think that will be a bit ugly, unfortunately. And then also, of course, the bank pricing models, and I've touched on that, when they get updated to take into account the risk-adjusted return on capital. I think that will mean a lot of people face higher margins in the coming year, without a doubt. Obviously, balance sheet management for the banks themselves, they will have a look at where they get best bang for their buck, clearly, and I think we'll see a widening of risk margins based on risk grades. So, your better quality borrowers will perhaps feel it the least, which makes sense, but those who are at the other end of the risk spectrum will struggle significantly. And I think banks will be cautious about extending debt in certain sectors, and I'm thinking, retail, restaurants, bars and clubs, those sorts of things, because I suspect either it'll be priced at a level which will make it uneconomical, or else banks will just not be willing to extend their risk appetite there. And then if credit growth turns negative, what do banks do in terms of riding it out, and where do all those business development managers go? So lastly, in terms of how do we deal with this sort of approaching debt cliff as things tighten up? I think equity capital does become a more attractive option to businesses, where it's actually going to, I think, become priced more competitively to bank debt. The government will have to do some heavy lifting and focus on productivity reform to get some profitability back into the economy. We will see rationalisation. There will be business failures, unfortunately, and there will be a conversion of debt and equity from failing businesses, and it'll be picked up to those surviving. The question is, do we want to wait until this debt cliff approaches in September when all these schemes run out, or do those better business owners who are facing this problem get out quickly and do it beforehand? I do think that there'll be a change in the way we look at property ownership, because I think that with the failure of tenants, both retail and commercial, I think people will see that property ownership is not the safe haven we all thought it perhaps was over the last generation. And I think that'll also flow into bank lending, and I think it'll change the way banks look at freehold secured lending, and that'll flow into also their loss given default calculations as well. I think banks, though, will be sort of retreating to greatness. I think that there'll actually be less lending, but I think they'll have a way to support businesses by being close to them and continuing to understand where their needs are, and it will be back to being community partners. I think that there's actually a good path for banks to tread there. But I do think we're in for a painful process of deleveraging as credit growth tightens and turns negative, unless the government comes to the party and assists with further easing. So, it will be a long, slow way back. I think it'll be no better than what happened after the GFC and possibly worse. I think we'll be stuck in first gear for some time. I think very much that the bank's targets will move to minimising bad debts, unfortunately, for a period of time. Anybody who had asset growth targets, that's probably gone. I think banks will focus on risk assessment and appetite even more than they have in the last little while. I think discussions on margin will largely go out the door. While margins will be increasing for borrowers, it'll be the availability of credit and the willingness of a bank to partner with them. That's the key part. I do think that there'll be some reform and the move to cashless transactions. It's actually probably welcomed by the banks, welcomed by businesses that actually prefer people to use tap and go and credit cards, and I think this will hasten the move in that direction. We might get rid of checks as well at some point, and that would be brilliant for everybody, I think. So that will assist, and as I said, trust and support between a borrower and a bank become more important. So unfortunately, that's a little negative, but I think, in my view, that's unfortunately where we see things heading in the next 6 to 12 months and beyond. And that sort of brings me broadly to a close of what we've covered today. We do have a little bit of time for questions, and you're welcome to add some questions into the chat function if you'd like. While you're perhaps thinking about questions, I did just want to cover off that you're welcome to come and contact us if you'd like to discuss anything that I've said today. This is a webinar series that we're running every week. We have another webinar for you next week, and that will be run by Helen Newman, a partner in our business restructuring team. Helen will be talking about the pros and cons of business hibernation versus administration. And so that will be the context of the webinar for next week. And so we invite you to log in for that and listen to Helen. We don't have any questions at this stage. So again, you're welcome to contact me later if you wanted to discuss something offline. But given we're at 5 minutes to the hour, I'm happy to close this webinar here now. Thank you for logging in, and we look forward to working with all of our bank clients and stakeholders in the coming weeks and months. Enjoy your day. Thank you.